you keep yourself well and good and healthy. So just stay home and we will deliver to you your lessons. However, we need your full cooperation, which means that any assignment that may be given to you will be tackled by you responsibly. So let us start with our lesson for today. We are now on financial liabilities part 2. So our lesson is bonds payable. So we hope to accomplish these learning outcomes for this session. We will describe the nature of bonds. We will classify bonds. We will approximate the issue price of the bonds. We will journalize the issuance of the bonds, accrual of interest, and discount or premium amortization. So we will complete a cycle actually for bond transactions, and we will focus on term bonds. We will journalize early retirement of bonds payable as well as settlement of bonds on maturity date. And of course, one of the most important outcome for this session is that we will compute the financial statement elements relating to bonds at the end of the reporting period. So that is for proper financial statement presentation of the financial statement elements relating to bond transactions. So we now go straight to the first learning outcome. We will describe the nature of bonds. So as we discussed in our previous synchronous session, bonds are similar in some aspects with promissory notes. Bonds are formal certificates of indebtedness issued by an entity, and because the entity borrows funds from the public, so that these bonds can be afforded by small investors, they are issued in smaller denominations. So assuming that the company will borrow from the public investors 10 million pesos, these 10 million pesos will be divided into smaller denominations of say 10,000 or 20,000 or 50,000 or even 5,000, such that the bond certificate will indicate the face value of the bonds issued to a particular bondholder. Bonds have long-term maturity, that is from the date of issue, to give the issuing corporation enough time to accumulate enough funds for the payment of the maturity value or face value. Then bonds have long maturity period longer than the promissory notes, say 10 years, 20 years, or even 20 years. Bonds are traded in a capital market. So we have here primary market. When we say primary market, there exists a market between the issuing corporation and the potential bondholders. When we say secondary market, there may be transactions of buying and selling from the previous bondholders to some interested or potential bondholders. So secondary market means transactions between the investors. So this is buying and selling among and between the bondholders. Okay, we now go to classification of bonds. So as to payment of the maturity value, bonds may be classified as term bonds and serial bonds. Term bonds are those bonds that mature at a single date. So if we issue 10 million bonds, all of the 10 million bonds will have to be paid at a single date. Let us say 10 years or 20 years from the date of the issue or at the date that is indicated on the bond certificate. Whereas serial bonds are those bonds that mature in series of installments. Say, 10 million will have to be paid by the issuing corporation in installments of, let us say, 1 million annually for the next 10 years. Then we have registered bonds as opposed to coupon or bearer bonds. Registered bonds are those bonds whose names of the bondholders are maintained in the records of the issuing corporation, such that on the date of interest payment, the issuing corporation just prepares and issues checks payable to the registered bondholders. Whereas coupon or bearer bonds are those whose names of bondholders are not maintained in the books of the issuing corporation. Therefore, the mere possession of the bond certificate is enough evidence that we are the legal owner of the bonds, such that to avail of the periodic interest, the bondholders will have to surrender a coupon for the periodic interest payment. So there are a series of coupons, and each coupon entitles the bondholder to interest payment at each interest date. We have secured bonds, meaning they are protected by some assets of the issuing corporation. And we also have unsecured bonds, otherwise known as debentures. So if the security that is attached to the issued bond is a real property, then that bond is called mortgage bond. If the security used by the issuing corporation is a movable property such as vehicle or large equipment, then that secured bond is called chattel mortgage bond. If the security that is used by the issuing corporation is in the form of financial assets, say it's investment in other entities, then the bond is called collateral trust bond. May I repeat? If the security used is real property, the bond is called mortgage bond. If the security that is used is movable property, then the bond is called chattel mortgage bond. And if the security used by the issuing corporation is in the form of financial asset, so financial instruments also, then they are called collateral trust bonds. Whereas unsecured bonds do not provide any securities in the form of assets of the issuing corporation. Therefore, the only protection that is afforded to the bondholders is the good credit rating of the issuing corporation. So only a few corporations may issue unsecured bonds. Only those reputable corporation actually may have the opportunity to issue unsecured bonds. We also have convertible bonds and redeemable or otherwise known as callable bonds. So convertible bonds are those bonds which may be exchanged by the bondholders in the form of other financial instruments issued by the issuing corporation. Generally, convertible bonds may be exchanged in the form of ordinary shares of the issuing corporation, and the option rests on the bondholders. So the option to convert the bonds is given to the bondholders. However, there may be a certain period that is designated by the issuing corporation for the exercise of the conversion privilege. Whereas redeemable or callable bonds are those bonds which may be called in or retired by the issuing corporation even before maturity date. So this is redeemable or callable, meaning that they may be redeemed or paid even before maturity date. But that redemption date or call date is designated in the term of the instrument. Bonds do not always sell at face value, so the ideal is that the issue price of the bonds is equal to its face value. However, in most instances, bonds sell above face value or bonds sell below face value. So what are the factors that affect the issue price of the bonds? The factors may be grouped into two: the market factors, which include the risk in the business environment and includes also the regulatory environment as well as political environment. Market factors also include the current interest rates and the expected interest rates of similar instruments. Please take note that bonds are being traded in a capital market such that the issue price of the bonds will depend on the attractiveness of that bond compared with the other instruments in the market. So if market factors affect the issue price of the bonds, then entity-specific factors likewise affect the issue price of the bonds. When we say entity-specific factors, we mean the credit image of the issuing corporation. So the better is the credit image, the more impressive is the credit image of the issuing corporation, then the more attractive the bonds would be, such that the bonds would command a price higher than the face value of the bonds. Also, a factor will be the financial performance of the issuing corporation. So the more profitable, the more stable the issuing corporation is, then the more attractive would the bonds be for the potential bondholders. Okay, so how do we approximate the issue price of the bonds? So assuming that all other factors are constant, the issue price of the bonds will depend upon the interaction between the nominal rate, which is the rate stated on the bond certificate, and the market rate of similar instruments. The market rate is the rate that is offered by similar instruments in the market. So when the rate that is offered by the bond, which is the nominal rate, is higher than the rate that is given by similar instruments in the market, then the bond is considered to be attractive to the bondholders such that the bond may command a price higher than its face value. Therefore, the bonds are expected to sell above face, resulting in premium on bonds payable. So the excess of the issue price over the face value of the bonds is called premium on bonds payable. Whereas if we have the reverse situation, when the nominal rate, the rate that is offered by the bond, the specific bond, is below the market rate of interest, then the bond may not be attractive to potential bondholders, such that there may only be a few bondholders who may be willing to buy the bonds, and therefore the issuing corporation is expected to offer the price at an amount lower than the face value. Therefore, the bonds are expected to sell below face value. And the excess of the face value over the issue price of the bonds is called the discount on bonds payable. So let us apply. So how do we really determine the issue price of the bonds? For a term bonds or even for serial bonds, the issue price is equal to the present value of the face plus the present value of the periodic interest. To determine the present value of both the face and the periodic interest, the discount rate to be used is the market rate at the date of the issue. For term bonds, the face value is to be paid only once. Therefore, the appropriate PV factor that we will use is the simple present value. So in the present value tables, this is table 2. For term bonds, the interest is to be paid periodically such that equal amounts will have to be paid based on the face of the bonds. But the present value, to compute for the present value, again, the discount rate to be used will be the market rate at the date of the issue. Because this is periodic equal interest, then the PV factor that we will use will be based on table 4 of the present value tables. Table 4 is present value of ordinary annuity. So as an example, let us assume that the 1 million 8%, so 8% is the nominal rate, 5-year bond is issued on May 1, 2019. Interest is payable annually every April 30. So we will compute the issue price of the bonds under assumption 1 that the market rate on May 1, 2019 is 5%. And then we will also use assumption 2 that the market rate at the date of issue is 10%. Again, take note that the nominal rate here is 8%. In assumption 1, the market rate is 5%. So when nominal rate is higher than the market, bonds are expected to sell at a premium or above face. Whereas if the nominal rate, which is 8% in this case, is lower than the market rate, which in assumption 2 is 10%, then the bonds are expected to sell below face value, meaning in this case, it will sell below 1 million. Okay, so let us compute. Again, we go back to the basic premise in our example. So our concept is that the issue price of the bonds will be equal to the present value of the face plus the present value of the periodic interest, and the present value will be computed discounting the maturity or the face value and the periodic interest at the market rate at the date of the issue. Again, in assumption 1, the market rate on May 1, 2019, which is the issue date of the bonds, is 5%, such that 5% is the market rate, so we will be using that as the discount rate to compute for the present value. We will be determining the present value amount on the date of the issue, which is on May 1, 2019. The face value is 1 million. Therefore, on maturity date, we will be paying in lump sum 1 million. 1 million is to be paid after 5 years, and therefore we will be using the present value factor in table 2, present value of a single amount, which is 0.7835, rounding off to 4 decimal places. Therefore, the present value of the principal on May 1, 2019 is 783,500. The periodic interest that will be paid annually on these bonds is based on nominal rate. So that is 1 million times the nominal rate of 8%, which is 80,000. But 80,000 is to be paid annually for 5 years. And therefore, the PV factor that we will use is based on table 4, present value of ordinary annuity. So the present value of ordinary annuity at 5% for 5 periods at 5% for 5 periods is 4.3295, such that the present value of 580,000 to be paid annually is for 5 years is 346,360. Such that the total issue price of the bonds is above face value of 1 million. So the total issue price is 1,129,860. To record therefore the issuance of the bonds on May 1, 2019, our entry is to debit cash for 1,129,860, credit bonds payable at face value of 1 million, and the balancing figure is credited to an adjunct account premium on bonds payable of 129,860. So if the question is, what is the initial recognition basis? What is the amount that serves as the initial recognition basis for the bonds? The answer is still the issue price of 1,129,860. So even if the bonds payable is credited for 1 million, there is another account of 129,860 which in the statement of financial position will have to be added to the ledger balance of bonds payable to arrive at the total carrying value or amortized cost of the bonds payable. Now, you may be asking us the treatment of any transaction cost. So if the issuing corporation incurs transaction cost for the issuance of the bond, such transaction costs will have to be netted against the cash proceeds, and such will decrease the amount that will be credited to premium on bonds payable. If that is so, then you have to recompute for the effective interest because this one will become smaller. That means that your effective interest will not be 5% anymore because the lower is the present value, the higher will be the effective interest rate. So it will be slightly higher than 5%. Okay, let us prepare an amortization table assuming that the bonds were again sold for 1,129,860. So your beginning amortized cost is 1,129,860. For accounting purposes, we'll be recognizing interest expense equal to the effective interest. So based on this column, although we will be paying interest every interest date based on nominal interest, the difference between the nominal interest and the effective interest will be the amount that will be considered as premium amortization. 80,000 is fixed. This is 8% based on 1 million face value. The effective interest is moving because we start at an amount higher than the face value. Then in your first interest period, this is 5% of 1,129,860. And 5% of this amount is 56,493. The difference between 80,000 and 56,493 is the amount that will be taken up as premium amortization for the period May 1, 2019 to April 30, 2020. So that is 23,507. Then premium amortization means that we will reduce gradually the premium to bring it equal to zero on the date of maturity, and decreasing the premium will decrease also the amortized cost of our bonds payable. So 1,129,860 minus 23,507 is 1,106,353. Please take note that the amortized cost gradually decreases until it reaches the face value on maturity date, because that is one of the purposes of having the premium amortization. So the premium amortization gradually adjusts the initial issue price of the bonds to its face value come maturity date. Also, the premium amortization adjusts the nominal interest such that for accounting purposes, what will be recognized as interest expense will only be the effective interest. Again, for accounting purposes, the amount of interest expense that will be recognized will be based on effective interest, although we are paying an amount based on nominal interest. We are presuming in this case that the reporting period of the entity is the calendar year, such that adjusting entries will have to be prepared on December 31, 2019. Please take note again that your initial entry credits premium on bonds payable for 129,860. Okay, so before the first interest payment, there is an intervening date, which is the end of the reporting period. So that is December 31, 2019. Therefore, we will split 56,493 because 56,493 is the interest expense from May 1, 2019 to April 30, 2020. But we will update on December 31, 2019. So from May 1, 2019 to December 31, 2019 is 8 months. Therefore, 56,493 times 8 over 12 is 37,662. So we debit interest expense 37,662. Credit interest payable, that is for 8-month period. Interest accrues with the passage of time. So 80,000 times 8 over 12 is 53,333, such that the difference between the two is the premium amortization, which is computed this way also. That is 23,507 for 12 months, but for the first 8 months, which relates to the year 2019 over 12, that will only be 15,671. And therefore, this is your adjusting entry. Now, in our illustration, we opt not to prepare any reversing entries anymore, such that we go direct to the first interest period. That is on April 30, 2020, when we will pay our first 80,000. So we credit cash for 80,000, that is your first periodic payment. Debit interest expense to take up the remaining interest for this period, that is 56,493, but we have taken up 37,662 of interest expense last year. Therefore, the amount of interest expense for the first 4 months of 2020 is 18,831. Debit premium on bonds payable. So to update the amortization of the premium, that is 23,507, but we amortized last year already 15,671, such that your amortization from January 1 to April 30 is 7,836. Then cancel the recognized interest payable we set up last year. So we debit interest payable 53,333. Now the same process will be true at the end of 2020, wherein we need to update our accrued interest and the amortization of the premium. We are now entering the second period because the second period covers May 1, 2020 or April 30, 2020 to April 30, 2021. And then your amortization, your effective interest from May 1, 2020 to April 30, 2021 is 55,318. And that the premium amortization, again for the period April 30, 2020 to April 30, 2021 is 24,682. Therefore, we do it proportionately again. So from May 1 to December 31 of 2020, we take up the first 8 months. Debit interest expense, that is 8 over 12 of 55,318. So that's 36,879. Debit premium on bonds payable, that's 24,682 times first 8 months over 12 months, 16,454, and credit interest payable for 53,333. And the process is repeated until we reach the maturity date, April 30, 2024. We now go to our second assumption. Again, we now illustrate computing the issue price of the bonds when the nominal rate is lower than the market rate. So again, our concept is that the issue price of the bonds is equal to the present value of the face plus the present value of the periodic interest. Again, in computing the present value, the discount rate that we will use is the market rate at the date of issue. In our assumption 2, the market rate on May 1, 2019 is 10%, whereas the nominal rate is still 8%. So we have a 1 million 8% 5-year bonds issued on May 1, 2019, but the market rate on May 1, 2019 is 10%. Therefore, let us compute for the total present value of both the principal and interest on May 1, 2019. Again, the face value will be paid only once after 5 years, so the present value factor at 10% for 5 periods using simple present value is 0.6209. Therefore, the present value of the face on May 1, 2019 is 620,900. Again, the interest is to be paid annually every April 30 for the next 5 years. Therefore, 80,000 will have to be discounted again at 10% for 5 periods. Again, this time using the Table 4, present value of ordinary annuity for 5 periods at 10%. Therefore, the PV factor is 3.7908 such that the present value amount or 580,000 to be paid annually for 5 years is 303,264 such that the total issue price is 924,164. Based on this, our entry to record the issue of the bonds on May 1, 2019 is to debit cash equal to the issue price of 924,164, credit bonds payable for 1 million, and your balancing figure here is a debit. So debit discount on bonds payable 75,836. Again, to the question, what is the initial measurement basis of the bonds payable? The answer is still the issue price of 924,164. Even if in the ledger we have a credit to bonds payable of 1 million, we have another account which is an offset or a valuation account, an account that is deducted from the face value of the bonds payable to arrive at its carrying value or amortized cost. Therefore, we have 1 million bonds payable reduced by discount on bonds payable of 75,836. So the initial measurement basis of the bonds payable is still the issue price of 924,164. Again, if transaction costs are incurred, then the transaction cost will have to be netted again from the issue price such that the result will increase actually the amount of the discount on bonds payable. So if this will be decreased, that means to balance our entry, your discount on bonds payable will become higher. So any transaction cost is part of the measurement basis of the bonds payable. So if we issue the bonds at a discount, it will increase the initial discount on bonds payable, resulting therefore to a higher effective interest, meaning an interest rate, effective interest rate that would be slightly higher than 10%. So we prepare another amortization table. Again, our starting amortized cost is 924,164. Our nominal interest is 80,000 based on 8% of 1 million. Our effective rate is 10%. So we prepare a second amortization table. So we start on the date of issue for the amortized cost equivalent to the issue price of 924,164. Again, your nominal interest is fixed because this is term bonds. Your effective interest is equal to 10% of the amortized cost beginning. So this is 10% of 924,164. So this is 92,416. The difference between the nominal interest and the effective interest is the premium amortization, but in this case, your nominal interest is higher than the effective. Anyway, the difference between the two is your discount. Sorry for that. This is discount. This is discount amortization. So you just change that. I cannot edit anymore. That means I have to go back and okay, if you want to, okay, so let me edit and show. So this is again discount amortization. Okay, so this is slide 11. The reason why I do not want to go back is because I have animation. Okay, so this is it. Okay, so this is your discount amortization table. So our beginning amortized cost is 924164. Again, your nominal interest is fixed all throughout the 5-year period. This is 10% of the previous amortized cost. The difference between the two is your discount amortization. And because we start with a beginning amortized cost lower than the face value, as we amortize the discount, we need to reach an amortized cost equal to the face value of the bond such that your amortized cost increases as we reach maturity. Because your amortized cost increases, that means your effective interest likewise increases such that your discount amortization, because this column is higher than this column, your discount amortization also has the tendency to increase. So we go to the entries. Again, this is your interest expense from May 1, 2019 to April 30, 2020. But we have an intervening date, which is the end of the reporting period. So we need to prepare our adjusting entries. We debit therefore interest expense for 8 over 12 of 92,416. So that's 61,611. Credit interest payable, that's 80,000 times 8 over 12. That's 53,334. The difference between the two is your discount amortization for the period May 1, 2019 to December 31, 2019, which is 8,277. So that is 12,416 times 8 over 12. Your next date will be the first interest date, that is on April 30, 2020, when we will be paying the first 80,000. So we credit cash for 80,000, debit interest expense, that is for the period January 1 to April 30, 2020. So that is 92,416 minus the amount that was recognized already last year, 61,611. So that's 30,805. Debit interest payable to cancel the previously recognized interest payable at the end of last year, 53,334. Credit discount on bonds payable for the remaining amortization, that is 12,416 for 12-month period, again from April 1 last year to April 30 this year, but we have already amortized 8,277 at the end of last year, and therefore your additional amortization up to April 30 is 4,139. Then on December 31, 2020, we need to update again. So this is balance sheet date. So we need to prepare another adjusting entry. With debit interest expense, we are now entering the first 8 months of the second year. So from April 30, 2020 or May 1, 2020 to April 30, 2021, your interest expense for the 12-month period is 93,658, but we have again another intervening date, that is the reporting date. So for the first 8 months, 93,658 times 8 over 12, that's 62,439. Credit interest payable, 80,000 times 8 over 12, that's 53,334. And the difference between the two is your credit to discount on bonds payable. So that is 13,658 times 8 over 12, that's 9,105. If you are required to compute in your examination the amount of interest expense for the year 2020, that will be split into two now. That is from January 1 to April 30, your interest expense is 30,805 plus the interest expense for the period May 1, 2020 to December 31, 2020, 62,439. So your total interest expense is the total of these two amounts, 3805 and 62,439. Your amortized cost will be the face value minus the remaining balance of discount on bonds payable. Please take note that the discount on bonds payable is a real account. So from the balance last year minus the amortization last year, which is 8277 minus 4139 minus 9105, whatever is the balance will have to be deducted from 1 million to arrive at the amortized cost. Okay. We now compare interest expense, the amortization of the discount and the premium, and the carrying amount, meaning the trend in the carrying amount or amortized cost if the bonds were sold at a premium and when the bonds are sold at a discount. So we go to the premium first. So when bonds were originally issued at a premium, we started at an amortized cost that is higher than its face value. And therefore, on maturity date, we need to arrive at amortized cost equal to the face value. And therefore, the amortized cost is decreasing. Because the amortized cost is the basis for us to compute the effective interest, because your effective interest is equal to the effective rate times the beginning amortized cost. That means that your effective interest is also decreasing. What about our amortization, premium amortization? Our premium amortization is the difference between the nominal interest and the effective interest. The nominal interest is higher than the effective interest, and your effective interest is going down, whereas your nominal interest in amount is fixed. Therefore, the difference between nominal and effective is increasing. Therefore, the premium amortization is increasing as the bonds reach their maturity date. Whereas if the bonds are sold at a discount, we start at an amortized cost lower than the face value. Therefore, one of the purposes of the discount amortization is to bring this amortized cost equal to face value on maturity date. So we start with a lower amount going to the face value, which is higher. Therefore, your amortized cost is increasing. Because your amortized cost is increasing, which is the basis for the computation of the effective interest, that means that your effective interest is likewise increasing. Now, the market rate is higher than the market interest, or the effective interest is higher than the nominal interest. Therefore, this is increasing, whereas the lower amount is fixed. Therefore, the amortization for term bonds is likewise increasing. Therefore, this is a useful question in examination. What is the tendency of premium and discount amortization for term bonds? So whether the bonds were sold at a premium or at a discount, their amortization, whether premium or discount, is increasing. Okay, so far we have accounted for the issuance of term bonds. We have actually recorded the adjusting entry at the end of the reporting period to take up accrual and the update in the amortization of discount or premium. And in effect, we are recognizing interest expense equal to the effective interest. We now go to the recognition of bonds payable to complete the cycle of the term bonds. So how may we extinguish our term bonds payable? So bonds payable may be settled in different ways. They may be settled before maturity date. That means we may be willing to pay an amount which may not be exactly equal to the face value of the bonds if the bonds are to be called in from the open market, and therefore the retirement price may be dictated by the market price. Or we may wait until maturity such that we may be paying an amount equal to the face value of the bonds. Or we may settle our bond liabilities by exchanging these bond instruments into equity instruments, meaning that our bondholders or creditors may become shareholders of the entity. However, conversion of bonds into equity securities will be discussed in a different session, not at this session, because it will take too long if we finish conversion of convertible bonds. Okay, so what are the accounting procedures? We go now to early retirement of bonds payable. So if bonds payable are called in by the issuing corporation before maturity date, we have to do these accounting procedures. First, we need to update the accrual of interest and the amortization at the date of retirement. That is from the last interest date, or last year end, depending on the date of the retirement. Then you have to compute the amount to be paid. The amount to be paid is the retirement price. By the way, the market price of the bonds payable is quoted a certain percentage of the face value, such that when we say that the bonds are called in at 101, that means that they are retired at 101% of the face value. So if they are retired at 98, that means that they are retired at 98% of the face value. So when the bonds say, when the market says the bonds are quoted at 102, that means that the market price of the bonds is 102% of the face value. So 102 there is not a peso figure, unlike in shares of stock wherein the figure represents peso values, but for bonds, whatever is the figure is equivalent actually to the percentage of the face value. So after computing the amount to be paid, including the accrued interest from the last interest date, and updating the accrual of interest and the amortization of the premium or discount, then we are ready to recognize the bond liability and the related accounts. Related accounts here will mean interest payable on bonds payable, discount on bonds payable, and premium on bonds payable. So we need to compare two values, the retirement price. This is retirement price excluding the interest payment. This is retirement price on account of the face value only, which we need to compare with the carrying value of the bonds excluding the accrued interest, because in the retirement price we did not include the amount of interest that will be paid from the last interest payment date. Then in the carrying value, for this purpose, we also exclude the amount of accrued interest. So if the amount to be paid to settle this liability is higher, so yung ibabayad nyo ay mas malaki sa utang natin, that means it may not be favorable to the entity based on accounting records, because that is not favorable because you're paying an amount higher than your carrying value of the liability. Then the scenario results in loss on retirement of bonds. Whereas if the retirement price, the amount that you will pay to settle this liability, then you are doing the entity a favor. You are paying an amount lower than your debt, the carrying value of your debt. Therefore, that is a favorable situation. Therefore, the situation will require us to recognize gain on retirement of bonds. To exemplify, we will go back to our first scenario, that is bonds were issued at the premium. So we go back to this scenario that the bonds were originally issued at a premium of 129,860. Your original issue price is 1,129,860 for the total bonds with face value of 1 million. Such that we are going back to our earlier entries. In addition to this entry on May 1, 2019, we prepared this entry, adjusting entry at the end of 2019. This entry for the first interest payment for 2020 and this year-end adjustment for 2020. We proceed to 2021. So let us proceed to 2021. Therefore, your last year-end adjustment is this. We are now in this period. We are entering the second period at the end of 2020. This is again from May 1, 2020 to April 30, 2021. Hence, this adjusting entry based on this level. Okay, so that means in 2021, on April 30, 2021, we are paying our second interest payment. So we credit cash for 80,000. This one. We are to update our interest expense up to the date of payment of the second periodic interest. This is 55,318 minus the amount that was recognized in 2020. So that's 18,439. We again take up the remaining premium amortization, that is 24,682 minus 16,454, so that is 8,228. And we cancel the previously recognized interest payable at the end of 2020, that's 53,333. And then on December 31, 2021, we prepare another adjusting entry. Debit interest expense for 54,084. We are now in the third interest date. We are entering the first 8 months of the first interest period. So again, from May 1, 2021 to April 30, 2022, the interest expense there is 54,084, but interest accrues with the passage of time. So 54,084 times 8/12 is 36,056. Again, credit interest payable, 80,000 times 8 over 12, 53,333. And the balancing figure is debited to premium on bonds payable for the amortization from April 30 to December 31. That is 25,916 times 8 over 12. Then, on April 30, so again, if the question is how much is interest expense for the year 2021, that's the total of 18,439 and 36,056. If the question is how much is accrued interest or interest payable at December 31, 2021, that is 53,333, because this debit only cancels the previous credit that we set up last year. Therefore, in year 2022, on April 30, 2022, when we pay the third periodic interest, we debit interest expense, that's 54,084 minus the amount recorded at the end of last year, 36,056, so that's 18,028. Update also your premium amortization. So debit premium on bonds payable, that's 25,916 minus the amount that was amortized last year for the first 8 months, 17,277. So that is 8639. Debit interest payable to cancel the interest payable that we recognize at December 31, 2021. So that's 53,333, and credit cash for 80,000. Now, let us assume that 400,000 of the bonds were retired on June 30, 2022 at 101 plus accrued interest. So we will update. The last payment of interest was made on April 30, 2022. So the last was this. We made our the most recent interest payment based on this table, this one, on April 30, 2022. But 2 months after that interest payment, 400,000 of the bonds were retired on June 30, 2022 at the retirement price of 101. 101 is the retirement price on account of face value. The term used here is plus, not including. Therefore, this is retirement price on account of the face value. To compute for the total cash paid, we need to add the accrued interest from April 30, 2022 to June 30, 2022 only for the 400,000 bonds that are to be retired on this date. And therefore, we compute. Our retirement price is 101% of 400,000, which is 404,000. We will update the carrying value of the bonds retired on June 30, 2022. Therefore, based on the table, the latest carrying value available is as of April 30, 2022. Hence, we go to amortized cost. The amortized cost is 1,055,754. But this 1,055,754 is the amortized cost of the full 1 million bonds. We are retiring only 400,000 of the 1 million bonds. Therefore, we determine the proportionate amount that is as of April 30. That is 1,055,754 times 400,000 over 1 million. Therefore, the amortized cost as of April 30, 2022 of the retired bonds is 422,301. However, we need to update the amortization of the premium up to June 30, 2022. Therefore, we are now entering this period already because this is amortization from April 30, 2022 to April 30, 2023. Therefore, from April 30 to June 30, 2022 is the first 2 months of this period. So 27,212 times, determine the proportion of the 400,000 over the 1 million, times 2 months over 12 months, therefore 1,814. Again, take note and please be reminded that the premium amortization decreases gradually the carrying value of the bonds. Therefore, this is the carrying value of 400,000 as of April 30, 2022, minus the 2-month amortization from April 30 to June 30, 2022, relating only to the 400,000 bonds to be retired, so that is 1,814. Hence, the carrying value of the bonds to be retired is 420,487. But we are able to retire it only at 101. Therefore, the retirement price is lower than the carrying value of our debt. That means, therefore, that this is favorable to the entity. Hence, the difference between these two is gain on retirement of bonds. Now, how much is the accrued interest that will be added to our retirement price? That is, you are to compute the accrued interest on the bonds to be retired, meaning on 400,000 only from April 30, 2022 to June 30, 2022. That is 400,000 times 8% times 2 over 12. Or you may get it from here, that's 80,000 times 400 over 1,000 over 1 million, 400,000 over 1 million times 2 over 12. Therefore, the amount of accrued interest that will be added to 404 to arrive at the total cash paid will be 5,333, such that the total cash paid will be 404,000 plus 5,333. So your total cash payment to retire the bonds, including payment for accrued interest, will be 409,333. And therefore, update the accrual of interest and amortization as of June 30. That is, again, we are in this section of the amortization table that is on the 4th interest period already. So we'll take up 52,788 and 27,212 as partial amortization. Okay, therefore, we debit interest expense for 52,788 times 400,000 over 1 million times 2 over 12. That's 3,519. Debit premium on bonds payable for 27,212. That is your amortization based on that line also, times 40%, which is 400 over 1 million times 2 over 12, that's 1,814, and credit interest payable for 5,333. So after updating our accrued interest as well as the premium amortization, we are now ready to recognize the bond liability. Therefore, to record the retirement, we debit bonds payable, 400,000. We are now canceling this interest payable. So debit interest payable, 5,333. Go back to our computation here. Our carrying value of the bonds retired is 420,487, but the face value of the bonds being retired is 400,000. So that means that the related premium thereon is 20,487. So that means we need to recognize that premium of 20,487. Credit cash equal to the retirement price plus the accrued interest, that's 404, plus the accrued interest of 5,333. So total cash payment of 409,333. And credit as the balancing figure the gain or retirement of bonds for 16,487. Again, these entries are dated on the date of the retirement, early retirement, that is June 30, 2022. Okay, I will pause for you to breathe. So what happens next? How much bonds are still outstanding? Do we still have liability for bonds? Yes, because out of the 1 million, we only retired 400,000. That means therefore that there are still 600,000 of the bonds is still out with our remaining bondholders, and therefore our entries will continue. Therefore, subsequent to the retirement of these 400,000 bonds, we need to prepare entries relating to 600,000. Please take note that even if we prepared entries on June 30, 2022, these entries pertain only to those bonds that were retired. So to those bonds that are still outstanding, yung natitirang 600,000, the last entry for the updating of the premium amortization was made on interest date, that is April 30, 2022. Therefore, from April 30, 2022 to April 30, 2023, we are now in this period because this is dated December 31, 2022. Therefore, that date will be within these two dates. Therefore, we will take up the second to the last row. That is your effective interest from April 30, 2022 to April 30, 2023 is 52,788, and your premium amortization for the same period is 27,212. Therefore, on the remaining 600,000 bonds, 52,788. So we debit interest expense 52,788, but this pertains to 1 million. Our remaining bond liability is only 600,000. So times 600,000 over 1 million times 8 months over 12 months, that is 21,115. Oh, do the same thing with premium amortization. So debit premium on bonds payable, that's 27,212 times 600 over 1,000 times 8 over 12, that's 10,885. And credit interest payable, that's 80,000 times 600 over 1 million times 8 over 12, or simply 600,000 times nominal rate of 8% times 8 over 12. Therefore, that's 32,000. Okay, so we pause and we compute for some financial statement elements before we finally reach the maturity date of the remaining bonds. Therefore, as of December 31, 2022, what amount of bonds payable shall be present in our statement of financial position, and what interest expense shall be present in the statement of comprehensive income. Okay, so to compute for the interest expense for the year 2022, again from April 1 to April 30, that is April 30 because we are still in this level. That is the remaining 4 months over 12 months of 54,084. From January 1 to April 30, all of the 1 million bonds are still outstanding, and therefore no need for us to prorate. We are to prorate only the number of months. So 54,084 times 4 over 12, that's 18,028. And then from May 1 to June 30, we are now transferring to this level. Again, from April or May 1, 2022, up to the date of early retirements, June 30, 2022, before retiring the 400,000 bonds, all of the bonds are still outstanding. However, we are now transferring to the next row, 52,788 times the first 2 months there, times 2 over 12. Therefore, that's 8,798. Then, at June 30, we retired 400,000 of the previously issued 1 million bonds. After retirement, therefore, of this 400,000, the remaining outstanding bonds is 600,000. So 600,000 times 600,000 over 1 million is just 0.6 or 60%. And therefore, 52,788 times 600 over 1 million times number of months from June 30 to December 31, that's 6 over 12. Therefore, our interest expense for the period June 30 to December 31, based only on the remaining outstanding 600,000 bonds, is 15,836, such that your total interest expense for 2022 is 42,662. Therefore, if you are to prepare your entries, or if you are to post your entries for interest expense for 2022, that is 18,028, not necessarily the same amounts there. Plus 3,519. Plus 21,115. Your total will approximate 42,662. There may be difference of a few pesos only due to rounding off, but that is okay. Now, for the financial statement elements, in the statement of financial position for the bonds payable, what will be presented as its amortized cost. At April 30, 2022, this one, your amortized cost of the full 1 million is 1,055,754. However, the remaining outstanding bonds is only 600,000 after retiring the 400,000. So the amortized cost is 633,452. But that is as of April 30, 2022. Then determine your amortization of premium from May 1 to December 31. That is 27,212. So we are computing based solely on the table, not necessarily based on your posting in the general ledger based on your journal entries, but based on your table only, because this is the procedure that you will do in your examination. So that is 27,212 times the proportion of the bonds is still outstanding, 600 over 1,000 or 0.6, times number of months from April 30 to December 31, 8 over 12. Therefore, the amortization there is 10,885. So, this is your amortized cost proportionately based on the table as of April 30, 2022, minus your amortization for the period May 1 to December 31, 2022, pertaining only to the 600,000 bonds is still outstanding. Therefore, the carrying value of the bonds before interest payable is 622,567. Now, why are we separating the interest payable? Because your bond liability is due on April 30, 2024. The balance sheet is dated as of December 31, 2022. So this is as of December 31, 2022. Your due date is April 30, 2024. Therefore, it is due beyond 12 months from the balance sheet date. Therefore, the amortized cost of the principal is presented as non-current liabilities. So, any other financial statement element related to the bonds payable? Yes, there is. We have interest payable, but interest is payable periodically. In fact, our next interest payment will be due April 30, 2023. Hence, the interest payable is classified as a current liability. And your interest payable there is 600,000 times 8% times 8 over 12 based also on our previous entry, adjusting entry. So that is 32,000. Again, in the statement of comprehensive income for the year 2022 from January 1 to December 31 for 12-month period, based on the movement of our bonds payable, our total interest expense is 42,662. Whereas your bonds payable in the non-current liability section of the statement of financial position, the bonds payable will be presented at 622,567 inclusive of premium on bonds payable of 22,567 because the face value is 600,000. Then in the current liability section of the statement of financial position, we will present interest payable amounting to 32,000. Now we are in the year 2022. Okay. So that we now proceed to 2023 just for us to reach the maturity date, which is April 30, 2024. Again, please take note that the last adjusting entry that we prepared was dated December 31, 2022. Therefore, on April 30, 2023, we will continue paying for the accrued interest, but the accrued interest or the periodic interest, but the periodic interest will be based only on the 600,000 bonds still outstanding. So your credit to cash there is 600,000 times 8%, which is 48,000. Where are we now? We are in this level here. Debit interest expense, that is 52,788, this one, times 0.6 times 4 months from January 1 to April 30, 4 over 12, so that's 10,558. Debit premium on bonds payable, that is 27,212 times 0.6 times 4 over 12, 5,442. And we cancel again the previously recognized interest payable set up on December 31, 2022, 32,000. Then on December 31, 2023, we update again the accrual of interest and the premium amortization. So with debit interest expense, we are now on the last line of our amortization table, times 0.6 times the first 8 months over 12 months, 20,583. Credit interest payable, that is 600,000 times 8% times 8 over 12, sorry for this, that's 32,000. And your amortization from April 30 to December 31 will be based on this last 28,542 times 0.6 times 8 over 12, that's 11,417. Okay, therefore, any remaining balance of the bonds payable with corresponding premium on bonds payable based on your ledger balance or based on your amortization table. So whatever is the carrying amount will already be classified as current liabilities. at December 31, 2023 because your due date is already April 30, 2024. So it will mature only 4 months from balance sheet date. So the bonds payable with premium on bonds payable as well as interest payable, you may combine all of them together. So that's your updated amortized cost so that total amount will be presented as current liabilities, or you may show bonds payable with premium on bonds payable in one line item and then interest payable in a separate line item. However, both of them will be presented as current liabilities. Okay, so excited much because we are now nearing the end of the table, which is April 30, 2024. Therefore, on maturity date, so even on maturity date, we are paying our last 80,000, and therefore we will update also the premium amortization such that after the last premium amortization, your premium on bonds payable will have to be brought to zero already after recording the retirement. So how do we do that now? Okay, so we debit interest expense, that is 51,458 times 0.6 times 4/12 based on this. Debit premium on bonds payable, same computation, that is the last 4 months of 28,542 based only on 600,000 bonds still outstanding, or you just deduct the previous amount we recorded last December 31, 2023. Recognize your interest payable that was recorded last year, credit cash for 48,000. We are preparing 2 separate entries to record the payment of the last periodic interest that is for 48,000 and to record the settlement of the 600,000, because here we have updated the premium and the premium should be brought to zero already after this entry. Then your entry here to record the retirement is just to debit bonds payable 600,000, credit cash for 600,000. Therefore, on maturity date, there is no gain or loss arising from the retirement because premium or discount has been properly amortized already. After posting the last entries in the books, meaning in the ledgers, not the textbook, of course, the bonds payable and the premium on bonds payable should have been brought to zero balances. And therefore, to ensure that the premium has been brought to zero balance already, then you have to go back to your transactions. That originally we set up the premium at 129,860 at the date of the issuance. Then we have the following debits based on the previous entries. You may go back to the previous entries. That means you should have taken them down in your notebook. We have a debit to premium on notes payable of 15,671, 7,836, 16,454, 8,228, 17,277, 8,639, 1,814, 20,487, 10,885, then 5,442 in 2023, and on December 31, 2023, 11,417, and then the last one we have 5,708. So after posting this debit of 5,708, have we reached a zero balance? Go back to your notebook. Have we reached zero balance? Actually, no. Because due to rounding off, there is still a difference of 2 pesos. And therefore, we make adjustments to the last entries. Hence, your interest expense has been adjusted. So to bring the premium to zero, from 5,708, we are now adjusting it to 5,710, such that the absorbing account will be the interest expense. So that's 10,290. That is from 10,288. Am I correct? 292. We are now decreasing it to by 2 pesos kasi it was absorbed by the debit to premium. So we are decreasing it by 2. So that's 10,290. So this is adjustment only to bring the premium exactly equal to zero, because there is no need for us to maintain the account premium on bonds payable because we have recognized already the principal account. Therefore, the auxiliary account will also be brought to zero, provided that your difference is not a significant difference. If the difference is a significant difference, then you have to go back to your previous entries. That means that there may be errors in your previous entries. After completing therefore this cycle, you have to repeat it all by yourselves now. You have to compute for the financial statement elements. Based on your entries, you may prepare entries or you need not prepare entries based only on your computations. So you are to do 5-18, 5-19, 5-20 from Intermediate Accounting Volume 1. Again, financial liabilities, meaning, yes, financial liabilities is the last chapter of Volume 1. Volume 1 focuses on financial assets and financial liabilities of financial instruments, except for shareholders' equity. That means, therefore, but that because we are already in the last chapter of Volume 1, you have to get ready of your Volume 2 Intermediate Accounting books. For our next lesson, you are to read Accounting for Convertible Bonds and Serial Bonds. And we are to prepare entries when bonds were issued between interest payment dates. So what have we accomplished today? We have described the nature of the bonds. We have classified the bonds. We have approximated the issue price of the bonds based on the relationship between nominal interest and market rate of interest. We have journalized issuance of bonds, the accrual of interest, as well as discount and premium amortization based on prepared amortization tables. We have exemplified entries for the early retirement of bonds, as well as the entries for the retirement of bonds on maturity date. We have computed financial statement elements, both in the statement of financial position as well as in the statement of comprehensive income relating to bond transactions. And therefore, that will be the end of this session. I'll be seeing you again in our next synchronous meeting. Stay healthy and stay home. Bye for now.